Hello everyone, welcome to today's presentation. We will be reviewing loan repayment. My name is Jo Cabrera Rosas. I am a senior advisor at the Financial Aid and Scholarship Office, and I'll be facilitating today's presentation. The agenda for today. We're going to be reviewing the federal loan portfolio and how to better understand it. We're going to talk about the current repayment plans and upcoming changes under the One Big Beautiful Bill Act. We're also going to look at a timeline of what to expect after graduation. And I highly suggest you review this entire presentation because we will be scheduling Q&A sessions with your schools. That way you can come with all of your questions and equipped with all of the information needed. The first thing we'll review is your federal loan portfolio. And the student loans that make up this federal loan portfolio are unlike any other loans out there or consumer debt. Consumer debts are things like car loans, mortgages, credit card payments, but student loans are very different because they're borrowed through Department of Education or a chosen loan servicer, and they have flexible repayment plans. So they have a variety of repayment options. They have the ability to use deferment and forbearance, and there's also the possibility for loan forgiveness. We will be discussing all of these in further detail later on. One of the things you had to complete in order to take out federal loans was a master promissory note or an MPN. This is a legally binding contract where you're basically promising to pay back the loans that you've borrowed. This also holds a unique multi-loan feature, so it's very possible that you only had to complete one or a couple for multiple loans. Now, it does detail your terms and conditions as well as your rights and responsibilities that we're going to review in further detail here. But I highly suggest that you download a copy of your MPN and have it easily accessible to you on your laptop somewhere because it is a legally binding contract. So some of the rights that are detailed in the MPN is your ability to prepay any loan without penalty. You're able to request a shorter repayment schedule. You're able to switch or change between repayment plans. And you're able currently to request deferment or forbearance due to unemployment or economic hardship for loans that are borrowed prior to July 1st of 2027. Some of your responsibilities, as detailed in the MPN as well, is having to pay on time whether you get a bill or not. You also need to make sure that you're updating your contact information so that the loan servicer is able to easily contact you in the future. So just make sure that your email, phone number, and address is up to date, whether you're moving for residencies or changing your email, whatever it is, you want to make sure that that is updated directly with them. And you also need to be completing the exit counselings for any Department of Education loans that would be completed at studentaid.gov. And for any institutional loans, it would be through ECSI Heartland. All right, so let's get some vocabulary down. Your lender can be anyone between Department of Education, or for institutional loans, CU, or for private loans, any bank or credit union that you chose to go with. Your loan servicer is who has been selected by the lender to service the loan, to take the repayments once you enter repayment. And so it can be a variety of these down here, loan servicers or ECSI Heartland for CU if you borrowed from the school directly. So the thing that we want to make sure that you understand is finding your federal loans and finding who your loan servicers are for your federal loans. So the best way to do that is you will want to log into studentaid.gov, which is the same place where you filled out your FAFSA, same place where you would have filled out entrance counselings and master promissory notes during your stay here. And you will log in with your FAFSA username and password. Once there, you'll have access to your dashboard. Your dashboard does review your loan history, and it has a very nice detailed disbursement review. You're able to track principal balances and accrued interest. You're able to have access to the repayment estimator, which is a very handy tool that we recommend that you use as you're getting ready to enter repayment. This is also where you can locate your loan servicer's contact information. So how you can do that, and we recommend you go into each loan that's listed on your dashboard individually, and when you click on it, you'll be able to see who your loan servicer is for each one of those loans. It will also have the contact information for them as well, and we highly recommend that you take note of each and every loan servicer you have. It is possible for you to have only one, but it is also possible to have multiple loan servicers. So the way to be sure is just check each loan individually. And then once you do have their contact information, go ahead and set up online access, just because that will make it easier for you once you actually enter repayment. On this slide, I have detailed the interest rates for the unsubsidized and graduate plus loan for the last 4 years. And it is important to note that while the interest is fixed for the life of that loan, interest can change from year to year. This is particularly important for students that are trying to tackle the higher interest loans once they enter repayment. It's just good to be very aware of what the interest associated to each individual loan is, so that you can make those options for any voluntary payments very targeted options. I also want to remind you that there is a 6 months grace period that you receive prior to entering repayment. But there's only one 6 months grace period. So for any loans that had previously entered repayment due to maybe a leave of absence that was longer than 6 months, or if you were out of school for longer than 6 months or more at a time, those loans will enter repayment immediately upon graduation. However, any loans that had not entered repayment do get one full 6 months grace period. When you log into your loan portfolio, you'll see that the principal balance is listed in one row and the interest is listed on a separate row, where the interest is accruing off of the principal balance. Once you graduate, capitalization occurs. And this is when your principal and your interest are lumped together to create one larger principal, and therefore your interest will start accruing on principal plus the accrued interest while you were in school. This occurs when you enter repayment. We don't know exactly when it occurs, and we don't understand the rules fully for that. So what we recommend students do is reaching out to their loan servicer to get the dates of when this will be occurring. Again, the homework that we put on the student is to call your loan servicer and ask what their capitalization timing is for the Stafford and Plus loans. You are able to obtain exact dates. And the reason why this can be important is because if your goal is to pay off your loans faster while minimizing the amount of interest you pay overall, it will help you, having a date from that a capitalization will occur, will help you prioritize payments to the higher interest loans prior to that date occurring. Now, you can make voluntary payments a couple of ways. The first way is you can make payments during your grace period. It is important to note that this does not waive the remainder of your grace period, and anytime you're making a voluntary payment, you can always specify to your loan servicer how to apply these payments. And this is where that chart from earlier can become very efficient, because you can select to pay your higher interest loans off or tackle those off first with the voluntary payments. Now you can continue to make voluntary payments even once you enter repayment anytime you send an extra payment aside from, of course, your required monthly obligation. And these ones can be paid towards those higher interest loans as well. And we always advise our students to make sure that your extra payments or your voluntary payments were applied how you meant for them to be applied. So deferment is a period in repayment where the principal and interest of your loan is temporarily delayed. You do not need to make payments while you're in deferment. But interest will continue to accrue on unsubsidized and graduate plus loans. Most of you guys may have used in-school deferment, where you weren't required to make monthly payments while you were in school. Now, it is important to note that currently you can continue, even once you graduate, to pursue deferment or temporarily stop payments due to economic hardships and due to unemployment, if you are not able to secure a job prior to entering repayment later this year. However, starting July 1st of 2027, economic hardships and unemployment deferments will go away, and the max deferment time frame will be 9 months within a 24-month period. Forbearance is similar to deferment, where it allows you to stop making payments or reduce your monthly payment for up to 12 months currently. While you're on forbearance, your loans will continue to accrue interest, both the unsubsidized and the graduate plus loans. Currently, the way that our students can use this is if they can't make their scheduled loan payments but don't qualify for a deferment, for example, like an in-school deferment, your loan servicer may still be able to grant you forbearance. With the upcoming changes to loan repayments, this option will become the primary option for those facing financial difficulties once the One Big Beautiful Bill Act goes into place. So starting July 1st of 2027, forbearance options, as detailed earlier, will have a limit of 9 months within a 24-month period, and interest will capitalize after that time frame. Time under forbearance will also not count towards any time-based loan forgiveness for those of our students that are enrolled in any PSLF or public service loan forgiveness programs. Delinquency and default. These are very bad things. Basically, delinquency, you become delinquent on your loan if your loan servicer has been trying to reach you and you just have stopped communicating with them or stopped making payments and they are unable to locate you. And so what they will do is they will place your loans in a delinquency status, your federal student loans. Consequences of this occurring to our students mean the first is your entire loan may become due and payable immediately. Any deferment, forbearance, or loan forgiveness, things that are with your file may become forfeited. You may be assigned to collections and charged additional fees. It will and may be reported to the credit bureaus, which would then definitely negatively impact your credit history. It can result in garnished wages and garnished tax refunds. And one of the worst ones here is unable to renew your professional license because now you have the degree, but you cannot work. So a way to make sure to avoid any of these horrible things is to really understand your loan portfolio, to set up auto payment so that you don't forget to make your monthly obligations, to contact your loan servicer before your payment is late, or if something comes up, medical circumstances, currently unemployment, if anything comes up, you always want to contact your loan servicer before a missed payment, because that way they can see what they can do on your file to prevent any type of delinquency. And you want to make sure that you're updating your budget regularly. If at any point your monthly obligations to your loans seem unfeasible, you want to be reaching out to your loan servicer actively to try to make that plan work for you, because you do not want to go into delinquency or default on your loans, as these have very negative effects on your credit overall. Now, this is a nice benefit to the federal student loans, is the ability for them to get discharged due to death or total permanent disability, bankruptcy, identity theft, or school fraud certification. Honestly, the main one up there is the death and total permanent disability. Your loans are able to be discharged if something like this were to occur to you. So now your family is no longer on the hook for paying these loans off. So it's just mainly the ability to get those discharged in the event of one of these horrible circumstances. All right, so now we're going to go ahead and go into the repayment plans and review the upcoming changes. So current traditional plans, they're all still active and live. The first one that is traditional is the standard plan. Standard plan is 10 years long. It is the highest monthly payments out of all of the traditional plans, but because of that, it does result in the lowest overall interest payments made. We also have the graduated plan, which is 10 years as well. It is more expensive than the standard because it works on an adjustment schedule. What that means is every 2 years, your payment is adjusted under the reasoning that once you graduate, when you're new in your field, you're likely getting paid less than somebody that has been there longer. And so that is why they expect an adjustment to your income every couple of years. And so your monthly payment steadily increases every couple of years, as is expected for your income to increase within your field. Now we also have the extended traditional plan, and that's basically just extended time frame. The time goes from 10 years up to 25 years. This does result in the lowest monthly payment out of the traditional plans, but because of that and the longer term period, it is the most expensive in interest overall. Here is the information on our current income-driven repayment plans. There are currently the income contingent, income-based, and pay-as-you-earn. As most of you know, the SAVE plan has been discontinued, so that is why it's not part of this chart. Income-driven repayment plans have plans that are recalculated annually using your updated income and household size. And so that is the one drawback to income-driven repayment plans, because they do require for your loan servicer to receive updated AGI and income information annually to continue to remain eligible for your chosen income-driven repayment plan. But you can use this in combination with any PSLF or public service loan forgiveness plans. And these are typically considered the safety net options for most students, and more of a temporary plan to ensure that you're able to meet your monthly obligations. In this chart, you'll see an intro into some of the upcoming changes that we'll review in the next slide, but I feel like this just summarizes everything so nicely because it goes into a bird's eye view of the monthly payment calculation under each of the plans, and it lets you see what's continuing and what's stopping as of the dates. So if we go into the One Big Beautiful Bill Act, this is going to go live in starting July 1st of 2026, where there's going to be a new tiered standard repayment plan. There's going to be a repayment assistance plan, also known as RAP, and this is going to be the one income-driven repayment plan option. Then obviously SAVE plan is eliminated, and those that choose to enter income contingent repayment or pay-as-you-earn will be phased out by July of 2028. So if these are your options, or if you choose either of those plans prior to entering repayment here shortly, that's fine. You can remain in those plans, but only up until the phase out on July of 2028. Now, overall, public service loan forgiveness remains unchanged. And here is a link to any OBA updates. All right, so let's review the changes starting July 1st of 2026. This is when the new tiered standard repayment plan will become available, and it will be a fixed monthly payment based on the amount of your federal loan debt, and that will then determine the repayment terms, which could either be 10, 15, 20, or 25 years. This is a plan that you can still use in conjunction with public service loan forgiveness programs, but only if you're under the 10-year term. This is also when the new RAP, income-driven repayment plan, will go into effect, and it will become the only option if you have not opted into another repayment plan. Payments are calculated based on a percentage of your income, and any unpaid interest is waived, so the loan balance does not continue to grow. Any remaining balance is forgiven or can be forgiven after the 30-year term of the RAP repayment plan. And this plan also eliminates the need to prove partial financial hardship, unlike the current income-driven repayment plans. Therefore, it does expand access to those with higher income. This plan can also be used with the PSLF program if all other requirements are met. Now, continuing on the changes. Borrowers in SAVE, Income Contingent or ICR, and Pay As You Earn or PAY will be phased out by July 1st of 2028. So you must choose a new plan by that date. So what that means is that you can opt to either of these plans, minus the SAVE plan that is eliminated, but the ICR and PAY, you can opt to those plans now. However, you will be faced, because they will be out and gone by July of 2028, you must choose a new plan by that date. Otherwise, you will be automatically placed in the new RAP plan. There is a legacy clause for IBR or income-based repayment plan because this is the plan that was passed by Congress. So for this one, it does allow borrowers to remain enrolled in this plan even after July 2028 when the other income-driven repayment plans will be phased out. However, you cannot take out any new federal loans as of 2026. So if you're going to be going back to school, it will negate the legacy clause for IBR and you'll only be eligible for either of the two new plans, which would be RAP, income driven, or new tiered standard repayment. It is also important to note that while the legacy IBR clause will be active for those that don't have any new federal loans, borrowers that switch out of IBR cannot re-enter it at a later date. Okay, well, at this point, the main thing to drive home is that you are in a unique situation where you'll still have access to the current traditional and income-driven repayment plans up until July of 2028 if you do opt into any of those. But you will also have access to the new either RAP or the new tiered repayment starting July of 2026. And so that's why it's important to understand both and to understand that regardless, there's stuff that's going to be phased out and there's very specific rules to meet in order to continue to be eligible for these plans, depending on what you choose to enroll on. So now we can talk about what to expect after graduation. And the main thing that is going to occur is that grace period begins. So for those of you that have not used up that grace period or entered repayment prior to going back to school, you do get that 6-month grace period. During this time, your unsubsidized and plus loans will continue to accrue interest, but you're not required to make monthly payments. Although any prior loans that did exhaust their grace period will enter repayment immediately upon graduation. During this time, you want to make sure that you're updating your contact information with your loan servicers and that you're organizing your finances and determining the best repayment plan for you. You want to be making use of the loan simulator at studentaid.gov, or if you gain access, once you gain access to your loan servicers websites, they also have very handy calculators that will help you determine the payments under each plan so that you can go ahead and focus on the 2 or 3 that make the most sense to you. During this time, you also want to make sure that you're securing employment so that you can have an easier time of entering repayment. And of course, any active duty students can go ahead and work with your loan servicer to submit any necessary documents for any delays and postponements in repayment. So financial planning. The very first thing you want to do is list all of your debts so that you can try to make up a list to pay those off wisely. You want to be establishing an emergency fund, which typically we recommend a minimum of $1,000. You also want to be seeking professional guidance if needed. We do get a lot of calls about, how to best file taxes, whether it's head of household or if it's best to do income married filing jointly. For a lot of that, our advice is very limited and can be very limited as we are not tax experts. And so you want to make sure that you're seeking the professional guidance where it's needed. You also want to prioritize and pay off the higher interest rate loans first. And in order to do that, debt stacking is going to be the way to go. So there is more information on debt stacking here. And we also included a resource here for personal finance advisors that historically have been very useful for our students. You also want to make sure that you're monitoring your credit. Lenders will check your credit when you're requesting financing, and so it's just always a good thing to do overall to make sure that you have an idea of what appears on your credit, to make sure that you're detecting any fraud early. You do have access to one free credit report every 12 months from each of the credit agencies, Equifax, Experian, and TransUnion. So we always recommend to stagger those and, maybe every 4 months or so, pull from one and then the next and then the next within that 12-month period so that you can have a really good idea of what appears on your credit. During this time in grace period, those 6 months, this is when you want to be selecting your repayment plans, reviewing your finances and your family goals. You want to be playing with that loan stimulator online. You want to be aware of the OBA deadline so that you know when to make those changes. So if you choose to go into an ICR plan because that's the one that makes the most sense to you, just know that you cannot get you only have that plan for up until July of 2028, and by then you have to choose a new plan. If you choose to do IBR, just know that that legacy clause is activated, so you can remain in that so long as you don't have a new loan after July of 2026. So there's a lot of things to keep in mind, especially with the One Big Beautiful Bill Act going into effect this year. If you are considering consolidation, which is basically when you're taking all of your varying loans with your varying interest rates and lumping into one big loan with one interest rate, you can do that, but you need to make sure you allow at least 3 months for that consolidation to occur. And just know that you can still consolidate after July 1st of 2026 and be eligible for the new repayment plan, RAP, or the updated version of the standard repayment plan, which is that tiered repayment plan we chatted about earlier. For those of you that are interested in the Public Service Loan Forgiveness Program, just be aware that it will continue to be around. There are no significant changes to this plan. And the way that it works is if you're working with a qualifying employer, you can make 120 qualifying payments, not necessarily consecutive, but qualifying. And once you make that 120th payment, the rest of your loan can be forgiven. Continuing with PSLF, it does require, again, the 120 qualifying payments. Currently, this can be used in conjunction with the qualifying repayment plans that will be phased out in July of 2028. Now, again, it's only the repayment plans that are being phased out. PSLF remains unchanged. And IBR, so legacy borrowers or the new RAP borrowers, or anyone in the 10-year tiered standard repayment plan will continue to qualify for PSLF. And you just want to make sure that you're checking with your employer regarding their classification so that they can move forward with employment certification firms if they are a qualifying employer. This will ensure that you are active in the PSLF, and then you just want to make sure you're tracking those payments so that you can submit for forgiveness as soon as you make your 120th payment. On this slide, I have basically just detailed what is a qualifying employer per Department of Education. The best way to really know if your employer is qualifying is to go directly to their HR, and they'll be able to answer that for you. All right, now we have the should I refinance? So refinancing is basically when you're taking your loans, your Department of Education loans, and you are opting to go into the private sector and refinance through them. So prior to doing that, really, we definitely recommend that you review your borrowing goals to really see if you should refinance. You really vet the company that you're thinking about refinancing with and the loan product that they are offering. You want to be sure that what they are offering as far as interest rates are fixed or versus variable. You want to understand the loan terms. Just know that anytime you're refinancing outside of Department of Education, your loans will no longer be eligible for PSLF or any term-based forgiveness because you're going into the private sector. So there is that elimination of flexible terms and conditions that you have when you have those loans through Department of Education. So really the only benefit for refinancing into the private sector is if your bottom line is debt elimination and the lender has said, I will give you this interest rate. And at the end of the day, that's all you care about is the interest rate because you know you're going to pay off your loans 100%. At that point, maybe it's okay to consider refinancing, but really that is the only benefit for those that are considering refinancing outside of Department of Education. All right, so here's where we start talking about repayment notifications. You can expect these from your servicer 60 to 90 days before your due date, before your official repayment date. During that time frame, you want to make sure that you're obtaining online access to your loan servicer's accounts. This will also facilitate it for whenever you make your monthly payments or your voluntary payments. You don't have to talk to anyone. You can just log into your website and make the payments from there. During this plan, you want to make sure that you're making those final selections with those repayment plans and that you're aware of those OBA changes. If you are going to be requesting PSLF or any income-driven repayment plans, during this time, you want to make sure that you're collecting all requested documents for the plan you're choosing and you're submitting it to your loan servicer on time. You want to make sure you're returning any requested information from your loan servicer at least 30 days before you enter repayment. It's just a nice thing to do to allow them to process your documentation on time so that by the time you make your first payment, you're already in your chosen plan. And during this time, you definitely want to be signing up for those automatic payments. The automatic payments do, one of the benefits of that is it does reduce your interest by 0.25% after 24 months of timely payments. For those of you that have private student loans, during this time, you want to make sure that you're reviewing the promissory note or your contract. You're really understanding your repayment date and the capitalization timing for your private student loans. You want to be looking into cosigner release options or requirements because there are a lot of lenders that offer cosigner release. You also want to make sure you set up those automatic payments, and borrowers can refinance private debt to lower interest or adjust for loan terms. So that's also a possibility. Regarding student loan interest deductions, You will be receiving a 1098-E form from your servicers annually, and you will use that to file your taxes to give you a little bit of a tax deduction based off of the interest accruals. So again, just remember that every year you should be receiving a 1098-E from your loan servicer that you will then use for a tax deduction. If you do not receive that, just go ahead and make a note to contact your loan servicer so they can send that out. So ultimately, you want to manage your loans and you don't want to let them control you. And the way you can do that is to really understand your student loan portfolio, to understand what your immediate family goals or financial goals are so that you have a clear idea of what is realistic monthly payments for when you enter repayment. All of these things need to be discussed and in order by the time that you enter repayment so you can assure that you have a successful repayment term. So don't be afraid of them, even though it might not be fun to look at the numbers and look at the interest. It might not be great to ask, when is this capitalization going to occur? And now I'm accruing interest on interest. But overall, you have to be educated in everything that is impacting your loans so you can make the wisest decisions for you and your family. But it is important to note that you're not alone in this circumstance. And if you have any questions, we are definitely a resource for you. So I have included all of our contact information here. I encourage you to give us a call if you have any questions. And ultimately, I know that a lot of information was thrown out, but we are here to help to the best of our ability. And thank you so much for coming to the presentation. I hope to see you in a Q&A session soon and to be able to answer any of your questions. Again, thank you and have a great day.